Alright guys, this is going to be the first video of our due diligence. So I'm going to try to do every week or every couple weeks to do a due diligence video, which is going to be, I'm going to be looking at stocks. And I'm going to pick one stock and I'm going to do some research on it and let you guys know what I think. Now this is not financial advice, investment advice by any means. This is just a research, a small research of the company. Now you guys can take what you want from it, make your own choices. At the end, I will be giving my opinion. That doesn't mean that is correct. So just fair warning, this is not advice by any means. So the company that I have found is Devon Energy Corporation, which is an energy core in the oil and gas industry. So as of, I don't know why I wrote the date like this, but oh sorry. As of March 1st, 2025, I should change this. Trading at 36.22 a share. Now you can see here, this is the description of the company. Devon Energy is a leading independent oil and natural gas exploration and production company. Their operations are focused onshore in the United States, and now the company's portfolio of oil and gas properties provides stable, environmentally responsible production and a platform for future growth. Devon's fourth quarter 2024 daily production was approximately 398k barrels of oil, or about 221,000 barrels of natural gas liquids and 1.4 billion cubic feet of natural gas. Now, I just got that from the company website. You guys can go on the company website and see the same thing. But here's some basic financial metrics that you can find on Yahoo Finance. So they have a price to earnings ratio of 7.94, and generally it's recommended that a price to earnings below 10 is generally good, because I'll explain to you guys what price to earnings is. So basically a PE ratio is how much the ratio that you would buy the company at, so to speak. So for example, if a PE is 10 and the company is, if the company is making, let's say, $1 million a year and the PE ratio is 10, it would be fair to say you should buy the company at $10 million, because the PE ratio is 10 times what the company is making. So in general, I've heard from multiple sources that below 10 P ratio is good. However, if it's a growth stock, high PE ratio could also be good, meaning there's possible, future growth within the company. Now they have an earnings per share of 4.56 and a market cap of 23.8 billion. Now the enterprise value is equivalent to the market cap plus the total debt minus cash and cash equivalents. Now you guys can see all this if you just go to Yahoo Finance, search up the ticker, and then you guys go to financials on the left, and you guys can see the income statement, the balance sheet, and the cash flow. So here we already got the market cap. We need the total debt, so you go over here and you go to total liabilities. You can see current debt and capital. This is short term, 485k, and then this you can see long term, 8.7 billion. So we added those up. We get 23.8 plus 9.2 minus the cash and cash equivalents. Again, you guys can just go here, go to assets, and here's the cash and cash equivalents. So we minus that, and all in total, we get 32.154 for the enterprise value, and that's in billions. So the market cap is 23.8 billion, and the enterprise value is 32.154 billion. So the EV is roughly 1.5 times the market cap, and this could signify a possible, like a good target for an acquisition. Now, it's important to keep in mind that the EV value includes all debt obligations the company has, which the buyer would then have to assume whether to buy the company, whereas the market cap is only reflective of the equity of the company. Now, here are possible negatives of the EV to market cap ratio. The EV proves a high debt load if it's higher than the market cap, because that means they're taking on debt, right, relative to the market cap. And the acquirer, or whoever's going to buy the company, may need to restructure or pay off the debt, which would increase the purchase value of the company, right? Nobody wants to assume a high debt load. Now, also, if the company is leveraged, it may be higher risk due to rising interest rates. However, the Fed has been cutting the interest rates in the past couple months, but they have slowed, and it's the economy, it's a little uncertain right now. But here are positives. The company could be undervalued if the business fundamentals are strong, and this might be considered on sale for the buyer of the company. If the company has strong cash flows, the debt might not be too much of a burden, right? Because if the company is making enough cash, they're just going to pay off the debt. So again, you guys can just go here and you guys can go to cash flow, and you can see annually. Last year they made 6.6 billion and they have a debt of 9.2 billion. So do what you will with that information. Obviously, they're probably going to be taking on more debt as the company lifespan. But regardless, it's good to look at the cash flows. Obviously, if the cash flow is very much lower than the debt, probably not a good acquisition. But another thing is that the acquirer can possibly refinance or negotiate a better deal on the debt. Now, let's move into the financial performance of DVN. As of December 31st, Devon Energy Corp has reported an increase of 4.5% in revenues, coming in at a revenue of $15.94 billion compared to $15.258 billion in 2023, with quarterly revenues growing at an average pace of around 7% per quarter. So that's pretty good, actually. However, it's important to note that the net income decreased by 639, sorry, this should be million, from a previous 1.15 billion due to higher expenses. Now I'll get into that later, why the expenses are higher. But also in accordance with higher expenses, DVN has also increased production by 28% to 848 barrels of oil per day, also known as MBO/D, in Q4 of 2024. And this is mainly driven by the acquisition of assets from Grayson Miller Energy, which is another energy company. And moving into acquisitions, as we just said, another acquisition, mid-2024, Devon Energy acquired the Williston Basin located in North Dakota for about $5 million, and that added 307,000 net acres to their drilling operations, which obviously you can see here enhanced position as one of the largest U.S. producers. Now, moving back to the debt, the acquisition increased Devon's debt by approximately $9.2 billion, as we saw before. However, Devon Energy has received a BBB plus rating, which basically just means it's an investment grade. As you can see here, BBB minus and above considered to be an investment grade, whereas a rating below BBB minus are considered to be speculative grade. So obviously BBB minus and above are generally considered quote unquote safer investments. You guys can look up the debt rating scale. A good movie on that is watch. What was it? The Big Short, I think. I think that was a movie about housing crisis, and there was a lot of talk about debt ratings. But regardless, they do have a decent debt rating, so that's something to keep in mind. And another thing to note is that their CEO is set to retire actually yesterday, as of this video coming out, March 1st, 2025, and the COO, Clay Gaspar, is set to take his spot. Now, I did some research on the new upcoming CEO, and it seems as he has lots of experience within the oil and industry, having multiple positions within multiple companies, and also 2 degrees in petroleum engineering. So that's something to keep in mind. And per dividends, DVN has raised quarterly dividends by 9% in February of 2025, which obviously investors like to see the dividends being raised. Now, here's a comparable company analysis. Obviously, the 2 big ones that we're going to be comparing are Exxon and Chevron, which are obviously humongous players in the oil industry. Now, last time I checked, which was yesterday night, Exxon is trading at, actually, this might be 211. Let me see. No, okay. So Exxon's trading at 111.33 a share, market cap at 483.08 billion, and the EV is at 508.36 billion. So you can see the ratio of EV to market cap, which is a little over 1, whereas the EV to market cap ratio for Devon Energy is significantly higher. And Exxon has produced 4.6 million barrels of oil equivalent per day, also known as BOPD, and it's up from a previous 4.58 million in Q3, which is not that much, about 20 million more, but it's something. Now, Chevron, again, you can just go to Yahoo Finance and check all this stuff, which is where I get all my information. Not all of it. I also go to the Devon Energy. I'll show you guys. You guys can just go to the website and you can look at their operations. You can look at their investor page, all that. But regardless, we can see the Chevron market cap is almost at 280 billion with an EV of almost 300 billion. So again, not a significant, not a significant EV to market cap ratio. That does mean they do have some debt, but that's not bad considering how much the company is valued at. And they did produce 3.35 million barrels per day in a decrease from 3.39, so about 40 million in Q3. Now, this is important to note that this is mainly because it was bolstered by a 14% year-over-year increase in the Permian Basin, reaching a record 992K barrels of oil per day. However, this growth is offset by factors such as I'm not sure how to pronounce that, Tengiz Several project, also known as TCO, and asset sales in Canada and Chevron's withdrawal from Myanmar. This is important to note. Also, Chevron operation has been significantly impacted by policy changes, including President Trump's revocation of Chevron's license, which would allow for exports of Venezuelan oil into the U.S., which means that just means Chevron cannot export Venezuelan oil into the U.S. anymore. And this is extremely important because operations in Venezuela have been a significant producer of foreign oil for the company. But as I said, both companies do not nearly have as much debt ratio as Devon Energy. Or sorry, not debt ratio. Enterprise value to market cap, which I guess is also kind of a debt ratio. But here's our basic conclusion. So Devon Energy's enterprise value is significantly lower than Chevron's or Exxon's market cap to EV value. Making Devon Energy very affordable for the company. So, for example, if we go back, we said Devon Energy has an EV of 32.154, and we can see here Exxon is almost at a 500 billion market cap. So 32 compared to 500 is a relatively small number, so obviously Exxon can afford the company. Exxon, since it's a large company, has the ability to take on debt and can withstand financial flexibility, as you can see on this balance sheet. Again, just go to Yahoo Finance and go to financials, and you guys can see all that. And based on my research, I believe an acquisition by Exxon is probably more likely, as Exxon has been seen acquiring smaller companies like this in the past to solidify its hold within the U.S. oil sector. Whereas Chevron's operational setbacks could be a problem for the future, which, if they're having setbacks in operations, then why would they want to acquire another company, right? Because they can't already need to handle their own operations. But regardless, both companies could grow their Permian Basin production had they were to acquire Devon Energy. Sorry, this should be Devon, I think. However, an acquisition of a smaller shale oil company like... Is it Devon or... Hold up. No, it's Devon. All right, I'm sorry I keep spelling this wrong. Oil companies such as Devon could pose possible threats of monopolistic practices. So obviously, if Exxon were to buy out Devon Energy, some people might view that as a monopoly. They might be investigated, as well as a threat of a changing political and macroeconomic landscape. We got, interest rates going on. We got political events going on. We got wars going on. So we'll see how it plays out. But overall, we see Devon Energy Corp as a potential target for potentially significant acquisition of one of these big players such as Chevron, Exxon, maybe another oil company if you guys have one in mind in the coming year or years. This is not saying this will happen. This is not saying Devon is a good buy. Based on my opinion, I do think Devon could have some sort of value that is in play here. Maybe potentially being acquired, as I said here. But once again, this is not any advice. This is just my research on the company and my opinion on the company. I do think Devon has a good potential value in the future. I'm not telling you guys to invest in the company. I might. I don't know yet. I'm going to hold off and see where the news takes us. But I just want to give you guys my due diligence on the company. And I hope you guys can find it informational. As always, do your guys' own research and make your guys' own decisions. This is not investment advice by any means.